Jason, hi. Thank you so much for spending time with me this afternoon. I can only imagine how busy these last few days have been for you.
Thanks for having me, Marianne. Yes, we've been fielding a ton of calls today. And on top of that, we proactively try to reach out to our clients as we do after every Bank of Canada rate announcement. When we see rate hikes as large as we saw today, it impacts affordability and qualification. So if we have clients who are currently pre-approved, we need to adjust their pre-approvals and walk them through what the new numbers look like.
That makes sense. Jason Friesen, managing partner at Outline Financial here in Toronto. He's one of the few mortgage brokers in the city that I refer my clients to. And Jason has taken care of my own personal mortgages, and I would probably say takes care of about 75% of my clients as well. Jason and I typically hop on the phone every week or so to get updates, so I figured that I would share this conversation with you today. So let's jump in. Jason, we saw the Bank of Canada's sixth rate hike announcement of 75 basis points this morning. I have to say, over the last month or so, I've been all over the map in terms of my predictions and what would happen this morning. So what's your reaction to all of this? Fill us in.
I think when we saw last month's inflation numbers come in slightly lower, everyone thought, or at least hoped, that the Bank of Canada would take maybe a softer stance on rate hikes. The lower inflation numbers were really brought on by lower gas prices, but when you look at the cost of goods, especially food costs, they were actually up substantially from the last year. So you had to look a little deeper into the numbers. After that, we had Jerome Powell, who's the head of the US Federal Reserve, say at the end of August that they were firmly resolved to bring down inflation and would keep at it until the job was done, which he said would bring pain to households and businesses. I think the markets took that as an eye-opener that we were not anywhere close to bringing inflation in check, and the rate hikes were nowhere close to being done. The Bank of Canada also said in their July rate announcement that they were not done raising rates. So I feel like this potentially was a bit more of wishful thinking than reality that they were done with raising rates. And as we saw today, it obviously went up 75 basis points. I wasn't expecting there was going to be a pause. I thought maybe 50 basis points, maybe 75, and we saw 75 basis points today.
The Bank of Canada has two more announcements to make for 2022, right? So we've got an announcement scheduled for October 25th, and then another one for December 6th. Where do you think we're going from here?
It's a good question. I think it's been proven the last couple of months it's impossible to try to predict what the Bank of Canada is going to do. I think when you look at the big banks' economists and their forecasts, for the most part, after the July rate hike, they were calling for anywhere between 1 to 1.25 in further rate hikes by the end of 2022. With this 75 basis point hike we just witnessed, and the Bank of Canada saying that more interest rate hikes were needed, I would not be surprised if we potentially see another 25 basis points both in October and again in December.
We've certainly seen and felt the impact on the Toronto real estate market from these rate hikes on my end. And that's been pretty hard and pretty fast since the spring at this point. In March, we saw an increase of 25 points. April was another 50. June was another 50, with the target overnight rate being at 1.5%. Then a full point in July, bringing the overnight rate to 2.5%. So this morning at 75 points brings us now to 3.5%, correct?
3.25%.
3.25%. Yeah. So let's talk interest rates. Where are variable and fixed rates right now as of this morning's announcements?
Yeah. So right now, we're seeing, so prime today is 5.45%. Depending on the client, you're seeing discounts anywhere between 0.6 to 1% below prime. So, you're looking in the range of, call it 4.85 to 4.45% that a client would be paying for a variable rate. Or a fixed rate, a 5-year fixed rate. 5-year fixed rates have not changed, just to be clear. Not to say that they won't, but they're not directly tied to what the Bank of Canada does when they set the overnight lending rate. Currently, we're seeing 5-year fixed rates as high as like 5.2%. In some cases, there are some preferred rates where you may be able to get down into the mid 4s, but I think 5.2% is a good number to use.
Can you explain a little bit about the importance of being pre-approved in the buying process? You and I talked about this a lot.
100%. And I know, Marianne, when you're working with clients, you're not showing them a home without confirming they've been pre-approved. It's absolutely important. And when we see rate hikes like this, they directly impact any borrower who has been pre-approved with a variable rate. A hike to interest rates means a decline in borrowing power. So having a pre-approval, if you are pre-approved for a variable rate, you definitely want to make sure that you are connecting with your mortgage provider and making sure that you have updated numbers. Again, I mentioned earlier, if you're pre-approved for a fixed rate, this rate hike to the overnight lending rate won't have any impact on that. But in any environment, it always makes sense to keep close contact with your mortgage provider, whether that be your mortgage broker or the bank that you're working with. And again, I can't stress the importance of making sure that you absolutely 100% have a pre-approval in place before you go ahead and start looking at homes. There's not a lot of room for error or wiggle room in this environment. So thinking you're approved is a lot different than going through the process and being pre-approved.
Question, are you finding that more people are going fixed or variable at this point?
So that's not a one-size-fits-all approach or answer. I think it really comes down to an individual client. But right now, majority of our clients are either going with short-term fixed rates, so 1, 2, or 3-year terms, or taking a variable rate and betting on the fact that we could potentially start to see rates come down by maybe the start of 2024 or maybe the end of 2023. And the consideration is that if you're looking at a longer term fixed rate, we're really looking at 5-year fixed rates that are at the same levels they were in 2008. And the biggest consideration with that is how the penalties are calculated if you were to break out of a 5-year fixed rate mortgage. If there was a reason why you needed to sell, or we saw a substantial drop in rates and you wanted to take advantage of that down the road, having a 5-year fixed rate would likely mean that you would be in a situation where you would have a massive penalty if you were to break out of your mortgage.
So let's say we've got a buyer who is looking to purchase at around $1.5 million. We're going to assume they're putting 20% down. They've saved for their land transfer tax, their closing costs, all of that. So basically they're looking at borrowing 1.2, right? Can you just explain the rates a little bit about back in February versus now? For sure.
So back in February, you would have been potentially paying, call it 1.45 for a variable rate and around 2.99 for a 5-year fixed rate. If we were calculating that over a 30-year amortization, and we would be looking at monthly payments for the variable rate of $4,110, and for the 5-year fixed, $5,040.
Okay, so then as of this morning and what today's rates are, what would we be looking at?
For sure. So I'm using 4.85 for today's variable rate, and that payment would be $6,297 a month. And using a 5-year fixed rate at 5.2%, it would be $6,548 a month. Remember, I mentioned at 1.45, someone's payment was $4,110.
Right.
With today's variable rate being $6,297, that's a jump of almost $2,200 a month. And on the 5-year fixed rate, going from $5,040 to $6,548, that's just over $1,500 a month in increased payments.
It's a lot of money.
It's a pretty substantial amount.
Are you finding right now that people who have variable rates on their properties are at all locking in and are feeling the effects of this, or not necessarily somewhere rates are?
I think at this point, it almost makes sense to try to ride it out. If you have certain circumstances and have no appetite for any further increases, then maybe converting to a fixed rate would make sense. But for borrowers who are anywhere between 4.45 and 4.85 for their variable rate, you'd be locking into a fixed rate that would be 5.2% or even potentially higher. So when you lock into an interest rate, it's not the same best rate you could get as a new client walking in off the street. The bank says you're getting their discounted rate, but it may be 5.49 you're locking into, whereas if you're a new client, you could get 5.2%. So when you compare where interest rates are at on the variable and where they're potentially, where they may go versus where the fixed rates are today, I think that ship may have sailed into locking in interest rate. At this point, I would almost suggest just riding it out.
Riding it out, that makes sense.
Yeah.
Okay, we talked about this a little bit with sort of the last scenario, but that $1.5 million buyer, some of my clients, for example, if their original budget was 1.5, they're still at 1.5. So obviously they're now sort of just being able to buy more of a house, let's say.
Yeah.
But at the same time, there are people who are now only going to be qualifying for 1.2 or something like that. So are you finding that people are still qualifying for the 1.5, or it's being adjusted?
These rates have had a huge impact. I'm going to explain just how the stress test rates work, because that's really what people qualify their mortgages based off of. So for the longest time, so the stress test rate that borrowers qualify for is either set at 5.25% or 2% above the rate that you're paying, whatever is greater. So when clients were at 1.45 for a variable rate or 2.99 for a fixed, they were qualifying based off of a stress test rate of 5.25%. Now, if you're looking at a 5-year fixed rate today at 5.2, that borrower is now qualifying based off of 7.2%. So an almost 2% increase in their qualifying rate. When we're looking at that $1.5 million buyer, the impact of higher rates mean that absolutely borrowers are now qualifying for less than they did in February. For example, to qualify for 1.2 as a mortgage in February, again, based on a 30-year amortization, a borrower would need to have about $225,000 in household income to qualify. Based on today's fixed rates and qualifying rates or stress test rate, a borrower would need to have $270,000 in income to qualify for that same $1.2 million mortgage. For a variable rate, a borrower would need about $260,000. It's a little bit easier to qualify for a variable rate as of today.
Let's say in many of the markets that I'm active in, prices are often down sort of 15% in many cases, sometimes more. So if you're buying that same $2.5 million house now for, let's say, 2.125, you're putting 20% down. It's a smaller down payment that you're putting down, but your monthly mortgage rates are now what at this point?
So let's just look at it using, again, the same 5.2% 5-year fixed rate for comparison's sake versus the 2.99 in February. So a $2.5 million purchase in February, 20% down, which is $500K, $2 million mortgage at 2.99%, it would cost a borrower $8,401 a month. Mm-hmm. And so now looking at 2.125 and looking at 20% down, which is $425,000, and taking a mortgage of 1.7, that's 80% of the 1.2 or 2.125, and using that rate of 5.2, a borrower would have a monthly payment of $9,276. So even though the price has dropped, a borrower has a higher payment, almost more than $800.
That's insane. So it's funny, just the interesting thing is that even though prices have decreased at this point, it hasn't actually gotten any cheaper to live in this city, unfortunately. When
you look at the scenario, it's actually quite a bit more expensive. And then on top of that, tacking on the additional cost of increases to almost all everyday items, it's become much less affordable.
So just to wrap this up here, if you had some advice to people who are just starting their sort of process of jumping into the market, what would you want to say?
Know your numbers ahead of time and know your budget. Work with someone who is interested in working through a plan with you versus just giving you a number and sending you out the door. While I think there are some great opportunities to be had, there have been and there still will continue to be some serious economic headwinds. I can't stress the importance of ensuring you're working with a competent mortgage person that will do more than just quote you a pre-approval amount and send you on your way. The way that I work, I always work backwards from a budget to make sure that the mortgage fits well within your lifestyle. Also planning for any kind of rainy day or emergencies at all. So again, I just can't stress enough, before you start to look at properties and fall in love with something, make sure that you can afford it and not just qualify for it, but actually afford it.
Jason, I really can't thank you enough for your time today. I know today's a busy one, so I really, really appreciate it. I hope we can do this again soon, and let's grab lunch over the next couple of weeks.
Sounds awesome. Thanks for having me.
Yeah. Bye.